Hey guys, Joshua here, and in today's video, I'm going to give you sort of a step-by-step beginner's guide to investing if you're like an absolute beginner and you want somebody to walk you through the entire process from beginning to end. Then this video is for you, so stick around and watch. Hey, really quick, if you don't mind just dropping a quick like on the video, also subscribe to the channel if you are new and you like content like this. All right, let's get started. So for starters, what exactly is investing? Like, what does that even mean? Simply put, investing is when you put your money into an investment vehicle such as stocks, bonds, or real estate with the goal of increasing it over time. Increasing your money without actually having to work for it is something that can only be done with investing. If you invest enough money over time, you'll grow your wealth exponentially thanks to compound interest, which is when you earn interest on top of interest repeatedly. And this builds massive wealth. All right, so the first step is going to be to determine what type of investor you actually are. This is going to be super important because this acts as sort of the cornerstone for your investing strategy, which we'll get to at the end of the video. The kind of investor that you are is ultimately going to come down to how comfortable you are with taking risk, right? Like, are you more comfortable with taking risk? Do you not mind it? Or are you very risk adverse, which means you are not comfortable with taking risk with your money and you would rather just play it safe? Generally speaking, there are three types of investors: aggressive, moderate, and conservative. Aggressive investors want higher potential returns on their investments, and so they're willing to take on more risk with investments like stocks and even crypto. Aggressive investors tend to be people who have many years until retirement and can hold through any market downturns. Conservative investors hate risk and don't mind losing out on higher potential returns in exchange for more peace of mind with investments such as bonds. Conservative investors tend to be people approaching retirement and can't afford to hold through any market downturns because they just don't have the time. And a moderate investor is someone who's a mixture of both. Not too hot, not too cold, but just right. So which investor are you? Which one do you resonate with the most, right? Like if you don't mind taking risk and you want higher returns and you're still young, then you'll probably be more on the aggressive side where you invest in a lot more stocks and crypto and even like real estate. But if you are maybe a little bit older and you're approaching retirement and you don't want to risk your money in the stock market, then you're probably going to be more on the conservative side of things, which is totally fine. There's no right or wrong answer with this. But I do want to say this: even if you start out investing and you say, Joshua, I'm terrified of the stock market, I don't want to put my money in the stock market, I think I'm a conservative investor, there is absolutely nothing wrong with that. And listen, you may start off your investing journey as a conservative investor, but as you get more comfortable with putting your money out there, you might transition into being a moderate investor, right? Where you buy some stocks here and there, and then eventually you might become more comfortable with the stock market and then realize that you want higher returns, and so you become an aggressive investor. Okay, so let's transition into the next part of the video where we talk about the different types of investments out there. So what I want to do is briefly go through and talk about all the major ones, sort of briefly explain what they are, so that when you have to decide on which investments you want to make, that you have a more solid understanding on what they are and how they work. Okay, so you've got stocks, bonds, mutual funds, index funds, exchange traded funds, also known as just ETFs, and then two different types of real estate. You can either invest in physical real estate or you can invest in a real estate investment trust, also known as REIT. And then of course there's other investments like options and futures, which are both derivatives. And then there's like banking products like CDs or like money market accounts. But I don't want to get into all of that because I think that just adds an unnecessary layer of complexity, especially for a beginner. Okay, so let's start off with stocks. What exactly is a stock? A stock is an investment that represents a share of a company. You'll sometimes hear people refer to stocks as equities, and that's because when you own shares of a stock, you actually have partial ownership of that company. For example, let's say you owned shares of stock in Apple. Well, that makes you a shareholder, and as a shareholder, that means you have a small stake in Apple, which means that you technically own a small part of Apple, which is pretty cool to think about. So as an owner, you'll experience different benefits. For example, some companies will pay their shareholders dividends. A dividend is basically just a piece of the company's profits that are then given to shareholders. The more profitable a company, such as Apple, the higher the dividend payments tend to be. Most companies typically pay dividends every quarter, and the size of your dividend payment is going to be contingent on how many shares of stock you own in that company. So the more shares that you own, the higher your dividend payment will be. Stocks are definitely a more risky investment, and it's not unusual to experience really wild volatility if you hold stocks in your portfolio. However, because they're more risky, it also means that your returns or the amount of money that you make will be much higher. Okay, so let's talk about bonds now. What are bonds? Very simply put, a bond is essentially a loan that you give to a company or government. In return, you'll earn interest, which is either paid out to you over time or once the bond matures. There's no reason to overcomplicate what a bond is. When you think of a bond, it's really easy just to think of it as like a reverse loan. For example, you may have taken advantage of federal student loans if you went to college, and these are basically just loans that are given to you by the federal government. Or if you go to the bank to get a personal loan or mortgage, these are loans that are given to you by an institution. Bonds are essentially just flipped. They're reverse loans. So instead of you going to a bank or the government to take out a loan and paying interest on that loan, you're giving a loan to a bank or an institution and they're paying you interest. There are many different types of bonds, such as corporate bonds, treasury bonds, municipal bonds, saving bonds, and a few more. Bonds are considered very safe investments, and some bonds, such as treasury bonds, are some of the safest investments in the world because they're backed by the United States government. However, because they are safe, it also means that your returns will be much lower than with something like stocks. Okay, now let's talk about investment funds. These are things like mutual funds or ETFs, REITs, index funds. These are all investment funds, and so they share very similar characteristics, but they are all fundamentally different from one another. An investment fund, such as an index fund or an ETF, is basically just a pool of money that's pulled together to invest in stocks, bonds, and other investments. Investment funds provide a much broader selection of investment opportunities that you otherwise wouldn't have access to as an individual investor. I like investment funds a lot, specifically ETFs, because they give my portfolio really broad exposure over different areas of the stock market, such as different sectors or indexes, without me having to do really any work at all. Unlike individual stocks, which only give you exposure to a single company, investment funds like ETFs give you much more broad exposure over hundreds and even thousands of different companies, all with a single share of an ETF. For example, in one of my investment accounts, I own a lot of shares of an S&P 500 ETF. So basically, this gives my portfolio exposure to all 500 stocks that make up the S&P 500, all of which are some of the biggest companies in the world. Normally, before index funds or ETFs, if I wanted exposure to the S&P 500, I would have to go out and buy every single stock in the S&P 500. And not only would that be expensive, but it would also be very time consuming. Or you could just go out and buy a single share of an S&P 500 ETF, and you would then gain immediate exposure to the entire index at a fraction of the cost. And then of course there's investments like REITs, which give you exposure to the real estate market without you having to ever go out and buy physical real estate. Now, investment funds come in many different shapes and sizes, and they can either be risky or not risky at all, depending on what's inside of the investment fund. For example, you can buy like bond ETFs, which only invest in bonds, right? And so obviously that would be a safe investment. On the other hand, an ETF like Vanguard's Information Technology ETF is going to be a lot more risky because it only invests in stocks in the tech sector of the stock market. Okay, so with all this information in front of you, it's now time to decide which investment's going to be best for you. And of course, I'll help you out with this part. I'll walk you through the process and like give you my recommendations for what I think you should invest in based off of what type of investor you are. So if you're a conservative investor or you feel like you don't want to take on too much risk, then I would recommend that your portfolio or what you invest in look like this. About 70% bonds, 20% stocks, and 10% in cash, perhaps like in your savings account or maybe some type of high yield savings account. Now, of course, these numbers are not like definitive, okay? This is just one example. If you say to me, Joshua, 20% into stocks is still way too risky for me, I don't want to take on that much risk, and then that's totally fine. Perhaps you do 80% bonds, 15% cash, and only 5% stocks, or maybe you don't want any stocks at all and you just want 99% of your portfolio to be bonds. The point is this: if you're a conservative investor or you feel like you are, then your portfolio is going to be very heavy in bonds, right? Like a majority of your portfolio or like what you're investing in is going to be bonds. Okay, now what if you are a moderate investor? Like you want a mixture of both safe and risky investments. What should your portfolio look like? You might do 45% in stocks, 45% in bonds, and 10% in cash. This of course can vary depending on which direction you lean. For example, if you wanted a moderately aggressive portfolio, then you would own more stocks than bonds. If you wanted a moderately conservative portfolio, you would own more bonds than stocks. In terms of what to buy to create this type of portfolio for yourself, I would recommend just a mixture of Vanguard's total stock market ETF and Vanguard's total bond market ETF. And finally, aggressive investors. If you are somebody who is very aggressive and you want the highest returns possible, then your portfolio is going to be very, very heavy in stocks. Your portfolio allocation might look something like this: 90% stocks and 10% cash, or 80% stocks, 10% bonds, and 10% cash. Or if you're feeling really crazy, just 100% stocks. The choice is yours. Ultimately, as an an aggressive investor, your main goal is to maximize your returns. And so you're willing to take on the most risk possible to get the highest returns, which means that you may even consider investing in cryptocurrency. For aggressive investors, I would recommend buying different types of stock ETFs. And so a few good ones are Vanguard's S&P 500 ETF, Vanguard's Information Technology ETF, and Vanguard's Total Stock Market ETF. All right, so by this point, you know the type of investor that you are, and maybe you know what type of investments you want to invest in. So what's next? So next you need to decide how much you actually want to start investing. A lot of this is going to depend on your investment goals and when you want to actually reach those goals. For example, let's say that you wanted to invest for retirement. Then it obviously makes the most sense to start investing as soon as possible and investing as much money as possible. To kind of give you some guidance on this, like as a general rule of thumb, if you're investing for retirement, then I would recommend that you invest between 10 and 15% of your income every single year. If you say to me, Joshua, that's way too much money, I cannot invest 10 to 15% of my income, I can't afford that, then that's fine. Maybe aim for 5%, right? The point is this, you want to try and maximize how much you're investing, because the more you're investing, the faster your money will grow. Now, for other investing goals besides retirement, there's two things you want to look at: your time horizon and the amount of money that you'll need. So let's go back to the house example. So let's say you were investing to buy a house in, I don't know, 5 years, right? And you needed 20% as a down payment on a $200,000 house. Well, that's $40,000 that you need to be investing over the next 5 years. That means that you would need to be investing at least $8,000 per year, or about $650 per month to reach that goal. Now, keep in mind, with the number example that I just gave you, I'm not actually factoring in the capital gains from your investment. So for example, you might only save up and invest $25,000, but over the next 5 years, if you're like aggressively investing in the stock market, then you might earn, like, say $15,000 from the capital gains of your investments. And so you technically only had to save $25,000 and you earned $15,000 in the stock market. Ultimately, when you're deciding how much you want to invest, I would recommend that you just work backwards. What's your goal? Is your goal to buy a house, to buy a car, to go on vacation, or is it retirement, right? Look at your goal and determine how much money you need to achieve that goal, and then just work backwards. Okay, so we're about halfway through the video, and congratulations, you made it. Okay, so now it's time for the fun part, which is choosing your broker, and then we're gonna actually begin building your portfolio by buying your investments. And by the way, I'll include links to all the brokers that we're about to talk about in the description below. So for starters, what exactly is a broker? You can't buy stocks in your bank account, right? Like, in order to buy certain assets, you'll need an investment account, and the only way you can open up an investment account is through a brokerage. They're completely free and also very easy to open, and so don't be intimidated by this process. Choosing a broker is typically going to depend on your investment goals. For example, if you wanted to invest for retirement, then you would obviously have to go with a broker that offered some type of retirement account, such as a Roth IRA. So for that, I would recommend going with a broker like Webull, M1 Finance, Vanguard, or Fidelity. There honestly is no right or wrong choice here, and ultimately it just depends on your personal preference. I would say the biggest thing to look for when picking a broker is to choose one that has the least amount of fees. Now, if you wanted my top choice for a broker, I would personally recommend Webull. It's what I use for my active investing account, and I honestly can't say enough good things about their platform and just how easy it is to use. Okay, so you may be thinking to yourself, Joshua, okay, so I've got the brokerage account that I'm gonna go with, but how do I actually open it up? It's very easy. For example, let's say you wanted to open up an investment account with Webull. You would either go to their website or download the mobile app and just sign up. Signing up typically entails you entering in personal details about yourself, employment status, and overall investment goals. It's a really easy process, and honestly, it shouldn't take you longer than 15 to 30 minutes. If you've ever opened up a bank account, then it's kind of the same thing. Once your account's created, you'll have to fund your investment account by transferring money from your bank account to your investment account through an ACH transfer, which typically takes up to 3 business days. So that's pretty much how it's going to be with every broker. I mean, I think that Webull is just a lot easier to use, and so I think it's going to be slightly easier to do this with Webull, but for the most part, all the other brokers will be somewhat the same. So by this point, you should have a really good idea of what type of investor you are, the type of investments that you want to invest in, how much you want to invest, and the broker that you're going to open. Now it's time to take all of that information and create an actual investing strategy. There are many different types of investing strategies out there. I mean, like way too many. So I'm just going to kind of talk about some of the big ones. For example, you've got active investing, index investing, growth investing, value investing, income investing, momentum investing, dollar cost averaging, and just a plethora of others. Ultimately, you should pick a strategy that aligns with your goals, time horizon, income, and risk tolerance. And by the way, you don't have to pick just a single strategy. You might use a combination of two of these. For example, if you wanted to start investing for retirement, you might choose a combination of dollar cost averaging, growth investing, and index investing. Dollar cost averaging just means that you invest more money over time. Index investing basically means that you only invest in investment funds such as index funds, ETFs, and mutual funds. And growth investing refers to buying shares of stock from companies that generate substantial and sustainable positive returns, such as Amazon. So I know it seems like there's a lot to think about, and there kind of is, but at the same time, I don't want you to overcomplicate the process and like scare yourself out of not investing. Let's do a really quick recap of everything that we just talked about so that when this video finally ends, that you'll know exactly what steps to take. Number one, figure out what kind of investor you are. Are you aggressive and you want high returns, and so you're willing to invest in things like stocks or cryptocurrency so that you can maximize your returns? Or are you conservative and you hate risk and don't care if you get smaller returns by investing in things like bonds? Or are you a moderate, somewhere in between, and you just want a balance of risk and safety? Number two, decide what you want to invest in. Stocks, bonds, ETFs, mutual funds, index funds, real estate through REITs, or even physical property. You can even use a robo-advisor. You know, like it's just a computer that creates an investment portfolio for you based on a set of questions it asks you. Number three, decide how much you want to invest and how much you can afford to invest each year or each month. Treat it like a bill and pay into your investment account as much as possible so that you can start building wealth for your future and reaching your financial goals. Number four, open a brokerage account. I would recommend Webull, but M1 Finance, Vanguard, and Fidelity are all really great options. Number five, choose an investment strategy. Remember, you can choose more than one. There is no one size fits all in investing. And finally, number six, just start. Don't wait until the perfect time, because that doesn't exist. The best time to plant a tree was 20 years ago. The second best time is now. And there you have it, how to start investing for complete beginners. I know that this was a long video, but if you watched through to the end, I really appreciate it. I hope that you got some value from this and that you can actually begin your investing journey successfully, and that I was able to help you sort of get there. If you found some value in this video, do me a huge favor, drop a like down below. I would appreciate that so much. Also, if you like content like this and you want to see more of it, please subscribe to my channel. And as always, I appreciate you so much for watching, and I will see you again very soon. Take care.